Look, I am well aware that some markets in the world look relatively bullish. Because of the low interest rates, companies with small earnings are getting
big valuations.
and when times are really good, almost too good, it's inevitable that we will see a correction. But when corrections happen, that money needs to go somewhere. It doesn't just disappear out of thin air. That money could go towards asset classes like bonds, real estate, or even Bitcoin. Or it could go towards the beaten up dividend stocks that's generating real cash flow with real earnings. So in this video, I want to talk about 3 ASX dividend stocks that I've been studying for 2021. Oh, by the way, if you want to see a video on Bitcoin as an asset class, just make sure you gently smack that like button right there, and I'll make that happen sooner rather than later. As usual, this video is no financial advice or recommendation for you to do anything. It's just general information for entertainment purposes. And no, I am not sponsored by anyone to make this video. So, without further ado, let's go! Okay, my filtering criteria for a great dividend stock starts off really simple. 1. Are they growing their earnings by double digits? Because if a company isn't growing their earnings, that dividend check isn't gonna last very long. And then 2, do they have strength in balance sheet to withstand any external shocks in the short term? And number 3, do they have some kind of competitive advantage that would defend their ability to generate cash flow in the future? Beyond that, I like to understand whether the company is growing its operating cash flows and the general prospects of the industry the company is operating in. Okay, the first dividend stock I've been studying is Elders. As of recording this video, Elders is trading for $10.70 per share with a 1.67 billion market capitalization and a 2% dividend yield. This is an Australian agribusiness providing agricultural goods and services for farmers in Australia and New Zealand. So think of providing farming supplies, fertilizers for farmers, and helping farmers sell their products. Besides that, Elders is also in the real estate and financial services business. Okay, let's take a look at what's under the hood. Over the last 5 years, they have grown their earnings by 14.2%. From a single glance, it should be pretty obvious that the short-term assets cover both the short-term liabilities and the long-term liabilities. That just means that they should have no issues handling any external shocks in the near term. And they have very little debt compared to the amount of equity they have. So there's plenty of room for the company to leverage if they want to. In the meantime, the balance sheet is relatively safe. On top of that, only 28% of their earnings are paid as dividends, so there are plenty of room to increase that dividend as the company mature. And it's just nice that the dividends are slowly growing. Okay, let's talk about Elders' competitive advantage and their future industry prospects. When it comes to Elders' economic moat, I can see glimpses of 2 moats. Elder is a brand that's wholly owned and operated by Australians owning 17% of the retail market share. The rest of the competitors are actually owned by foreign entities. Now the second moat is that Elders have cost advantage over its smaller competitors because of its scale. Now the cost advantage Elders have is relatively weak because that can be easily replicated when a company scale up. But the advantage of wholly owned and operated by Australians cannot be replicated, and it's in the best interest of our country to see them succeed. In terms of the future industry prospects, Department of Agriculture is forecasting the gross value in 2021 to grow by 7% to $65 billion. The main driver for that is the favorable growing conditions and the competition for cattle. And yes, I am well aware of the trade tensions between Australia and China, especially on barley and wine. Barley is likely to be redirected to other countries like India, and my understanding of Elders is that they have very little exposure to raw materials for wine. The next dividend stock I've been studying is real estate fund manager Primewest Group. The first time I came across this company is when David Allingham talked about them in LifeWire. They're very similar to other fund management businesses like Dexus or Charter Hall. The business model revolves around taking in institutional investors' money or really rich people's money, invest it strategically in real estate, and charge a management fee. The better they are at managing that money, the more money they'll be able to raise. And the more money they'll be able to raise, the more revenue this business is going to make. Since 2015, they have grown their asset under management by 15% compounded annually, and it doesn't look like it's slowing down anytime soon. Now, as of recording this video, Primewest is trading at $1.35 per share with a 470 million market capitalization. Their real estate portfolio is relatively diversified across these sectors, and majority of their assets are actually in WA, New South Wales, and Queensland. Actually, there are some in US as well. Now, because they have only been public for about a year, there's not too many data points to work with, but since that period, they have grown their earnings by 35%. As a fund management business, the balance sheet is squeaky clean. Short-term assets well cover short-term liabilities and all of the long-term liabilities. So there are plenty of room to maneuver if there was any near-term shocks. And there is no debt. As it stands, Primewest is paying approximately 54% of their earnings as dividends. So again, plenty of room to increase the dividends down the track. Okay, what about their moat and the future industry prospects? With a funds management business, it seems like to me that this is more of an intellectual capital business. So it's more about the talent and the track record of generating value for shareholders over a long period of time. So far, their funds under management have grown substantially over the last 5 years, which is a proof point that they can find efficiencies outside of the core market like New South Wales or Victoria. With industry prospects, I don't believe that office is dead. If anything, it's going to be a hybrid working environment, and retail isn't going to disappear either. Even though I'm a little bit more pessimistic towards retail, I find it very hard to comprehend a future without shopping centers. The third ASX dividend stocks shouldn't be a surprise, and that's Brickworks. Despite what everyone thinks, building products in Australia and North America actually makes up a pretty small percentage of group assets in Brickworks. Majority of the assets are actually in investments and property. As a matter of fact, Brickworks own 39.4% interest in Soul Pattinson, which is an ASX 100 diversified investment house. And then there is the joint venture on industrial properties with Goodman Group. The special thing about Brickworks is that they're one of the rare few companies on the ASX who have not decreased their dividends for 44 years. Even during the dot-com bust, which is right here, they actually paid out more dividends. And during the 08-09 crisis, the dividends have stayed the same and only recently started to grow again. But my question is, how long can they keep this up? Now, as of recording this video, Brickworks is trading at $18.56 with a 2.81 billion market capitalization and a 3% dividend yield. Now, over the last 5 years, they have grown their earnings by 19%. Now, it's important to know that even though the earnings growth trajectory looks really good, their EBIT and EBITDA did decline last year because of the pandemic. And earnings went up significantly because of this significant items net of tax. And as part of this line item, it actually came from owning shares in Soul Pattinson relating to the one-off profit triggered by the merger between Vodafone and TPG. Again, the question is, can they keep up with this earnings growth next year? Because that's important to not decrease your dividends paid next year. Looking at the balance sheet, short-term assets well cover the short-term liabilities, and that really just means that in the near term, with any external shocks, they should have no problem handling them. And there are very little debt on the balance sheet as well. So if they do want to leverage in the future, they do have plenty of room to leverage. Only 28% of their earnings are paid out as dividends, so there are a lot of room to increase the dividends as the company become more mature. Now let's talk about Brickworks' economic moat and their future industry prospects. Now bricks are incredibly capital expenditure heavy, and they're not very travel friendly. So the barrier to entry for new companies are really high. The fact that Brickworks is surviving and thriving after all these years are a testament to the quality of the management team. And their joint venture with Goodman Group on industrial real estate is really well placed to ride out the e-commerce tailwind. In the near term, the home builder program from the Morrison government is going to help Brickworks thrive in Australia. But with a second lockdown coming soon in the US, that's also going to negatively impact their sales over in the US as well. So what do you think? Was I overly pessimistic or optimistic for some of these companies? Or is there other better dividend stocks on the ASX that I should be really paying attention to? Let me know in the comment section below. So thank you so much for watching this video all the way to the end. If you do want to support the channel, not to mention some additional content pieces and my Discord server, consider supporting this channel via Patreon. Nevertheless, if you have learned something new, consider gently smacking that like button right there, subscribe to my channel, and click onto the bell so that when I release future videos, you'll be the first one to know. Until next time, my name is David. Otto will always do the honors and see you very, very soon.